Hi there, Anthony McCormack here from Heyman Partners Real Estate with edition 6 of our Market Wrap, covering off on what's making news in our real estate markets over the past month. National home values rose just 0.5% in July, the 18th consecutive monthly increase in home values nationally, following a 7.5% decline recorded between May 22 and January 2023. However, while the headline growth rate remains reasonably positive, it is clear momentum is leaving the cycle and conditions are becoming more diverse. Three capitals recorded a decline in values over the past 3 months, with the Canberra market dead flat in terms of growth. CoreLogic has noted available supply is a key factor, explaining the diverse outcomes in housing growth trends. The number of homes for sale in Brisbane, Adelaide and Perth is more than 30% below the average for this time of the year, while weaker markets like Melbourne and Hobart are recording advertised supply well above average levels. An erosion in borrowing capacity and affordability factors is skewing demand towards the lower price points of the market, with lower quartile values leading the growth trend across every capital city except Darwin and Canberra, which are also the two most affordable capitals after adjusting for local incomes. Units are now rising faster than houses across most of the capitals. The only exceptions over the past 3 months were Darwin and again the ACT, where affordability pressures are less pressing and a high history of higher supply levels across the medium to high density sector has become more apparent. Turning to rents now, and CoreLogic's rental index was only 1.1% higher in July, the smallest monthly rise since August 2020. A clear slowdown in the pace of rental growth across the unit sector has been the main drag on rental growth, especially in Sydney, where the annual change in unit rents has dropped from 18% in May last year to 6.6% this year. Melbourne and Brisbane unit rents have also lost more than 8 percentage points in the annual growth rate. We must note the slowdown in the unit sector rental growth is coming off a very high base. With value growth outpacing rental growth, we could once again see some downwards pressure on gross rental yields. The spread between investor mortgage rates and gross rental yields has widened significantly since the commencement of the rate hiking cycle. The underlying mismatch between housing supply and demand looks set to support housing prices through the second half of the year. However, there does seem to be some rebalancing underway. Real estate listings have been flowing onto the market at a pace slightly above average through autumn and winter, which has been testing the depth of the buyer demand. At a macro level, demand has been enough to absorb the higher level of advertised supply, but pockets of weakness are starting to emerge. This suggests there were still more buyers than sellers in the market, but sales and listings are starting to become more finely balanced. The outlook for the housing sector remains complicated. While constraints on new housing supply are likely to keep a floor under home prices and remain a feature of the market for some time yet, downside risks are growing. Housing affordability is becoming more challenging in markets where values are rising faster than incomes. Similarly, the portion of household income required to service a new mortgage was already at record highs in March and has likely risen further by now. That's it for this wrap. Thanks for watching. See you next month. Bye for now.